Greetings! It is Tuesday, which means it's time to talk stocks. Welcome to everyone who's joining us on our webpage, in YouTube, on X. My name is Brian Stoffel. You're used to seeing me here. I'm here every week with Brian Feroldi, but this week we've got a new stand-in here. Brian Feroldi is off on his annual skiing trip. So in his stead, we've got Ken Taylor. Ken, why don't you introduce yourself to everyone that's watching?
Hey, happy Tuesday, everybody. Yeah, my name is Ken Taylor. I do some work with Brian Stoffel in a program that we call Stock Investing Mentor. And, I got to know Brian a number of years ago. I have a master's in accounting, and I'm also, I have access to the Stock Simplifier program, too.
Look at that. You're not a completely unknown entity. We've got some folks on YouTube, Brandon, calling you out. So, Ken,
I see
welcome.
some familiar faces or familiar names, I should say. So, hey, everybody.
Now, Ken, just so people get a feel, how long have you been investing? Is there a type of investor you are?
I have been investing in individual stocks since 2022. I wouldn't say I have a particular style. I guess trend investing is definitely something for me. If there's a secular trend out there, I'm investing in it.
Okay.
But I think my meat and potatoes as an analyst is more value and lesser known stocks.
Okay. Well, that's a good foil to what Feroldi and I usually bring to the table. So let's get started today. This is our Stock Simplifier live workshop, and we're going to be talking about United Healthcare. Now, this is a stock that was picked because we put it out in our weekly newsletter, and this is what folks chose. Now, I will say before we get started, on the spectrum of easy to analyze, hard to analyze, I would say, Ken, that this is where United Health lands. But before we really dive in, we want folks to go ahead into the chat and let us know, yes or no, if this is a stock that you own or have ever owned. And Ken, while folks are replying there, I will ask you, is this a stock you've ever owned?
I did own this stock. It was a very small position.
Mm-hmm.
And I sold it after the unfortunate incident that happened, over a year ago now.
Okay.
After I kind of learned a little bit about the company's practices, and I had a feeling that some of their high margins might not be sustainable.
Okay. And just kind of looking through, I don't know about you, but it looks like there's a lot of people who don't. We've got a couple folks who do, some who used to. Susan says it's in her too hard box. I don't know. What kind of a breakdown would you say we've got here? How many percentage-wise have said that they own it?
Yeah, it looks like we've got at least 70% no's.
Okay. So most people don't, but a lot of people know that this stock is down a whole bunch. So if you know, Brian and I, we track our results, and one of the ways that we believe that we've gotten the results that we've gotten over the past 10 plus years is building a foundation upon which to do our own research. And so today our goal is that you will be able to research a stock from scratch. And to do this, we are using Stock Simplifier. Now you're going to see us use Stock Simplifier throughout this process. Because you have joined us, you can purchase Stock Simplifier by scanning that QR code. I'll leave it up there for just a second. A little bit later, Ken will throw a link to be able to purchase it for 50% off. You can also get to that using that. But this is what Stock Simplifier looks like. It's a 7-part way to research a stock from scratch. If you buy Stock Simplifier, it comes with a self-paced course. It comes with sheets to use. It comes with a bunch of custom AI prompts that you can copy, paste, and have our AI engines analyze. So as I said, it has 7 different parts. The first part is phase analysis. Now, every stock, we say, goes through some version of the business growth cycle, from when it is a startup, earning very little revenue, having huge losses, all the way to capital return, where dividends and buybacks are the bread and butter of everything. So let's start out with this question. Let's ask our group right here. Ken, what we'll do, actually, you know what we'll do, Ken, is I'm just going to show folks how this works. I'm going to go into Stock Simplifier, and I'm going to open up the AI prompt page right here. And what I'm going to do is I'm going to take the business phase analysis. I'm going to copy it. I'm going to go over into Gemini. I'm going to put it in. And hopefully this will ask me pretty quickly which ticker I want to do. It's coming up.
Our first answer coming in.
There we go. All right. So UNH is what we're doing. Now, what I would like to do is I would like to ask folks in general, what phase do they think the company is in? So go ahead, tell us, do you think this is phase 1, phase 2, phase 3, 4, or 5? What phase do you think it is in? Here again is another view of what that looks like. And then we can go and check and see what our AI had to say as well. Ken, it looks like we've got a pretty popular answer here.
We do. Not quite unanimous, but close. Everybody's clustered around that. So looks like 5 is our near unanimous answer.
All right. So the crowd says 5. Oh man. Tell you what, Gemini can work pretty deep sometimes. So I'm going to work on the quick mode a little bit. It says phase 5, and it says high confidence. It has operating income of 19 billion. Now that is a decrease, rather significant decrease from last year. However, revenue is growing. The big thing is $8 billion in dividends, $2.5 billion in share repurchases. It says that it's operating a massive diversified healthcare giant, despite a dip in operating income due to Medicare funding changes and cyber attack costs. It generates a lot of operating cash flow. If you want to value it, you should use trailing PE or trailing price to free cash flow. And it says what to watch: management's ability to navigate Medicare Advantage reimbursement headwinds and return to historical 5% operating margin. So that seems pretty unanimous to me. So if we go into the phase analysis, we're going to choose the capital return phase right here. Forgot to put in the ticker symbol, which is UNH. For some reason, I am in the view only version. Oh, man. Give me 1 second.
Can you make a copy of that?
You know what? Yeah, I should be able to make a copy of it.
Yeah. Now, for some of you, you might be asking, how's this capital return? The stock is way down. But as you probably saw, it's really more about how much money the company is returning to you.
All right, let's see if I can do it this time. Here we go. We're in the capital return, and we've got it. All right, so we're going to start out with the business description, which basically just aims to answer the question, how the heck does this company make their money? So what we're going to do is we're going to go through and we're going to figure out, how do they make their money? What do they offer? Who are the customers? Where do they operate? And then the big 3 is, how often do customers buy? Can they raise prices? And really importantly, what happens during a recession? So what I'm going to do here is I'm going to go to the business analysis. And if I click right here, it copies the whole prompt and I can just paste it right here into Gemini. I'll pull it up. Hopefully it'll ask me real quick. And then while it's doing this, Ken, what I was hoping you could do is just walk us through. So you bought a very small position a number of years ago, you said. When you did that, what was your thinking behind that purchase?
My thinking I was buying baskets of stock back then. I wasn't actually going too deep on analysis. So in my opinion, I just wanted some healthcare exposure.
Okay. And you just figured that was a good enough healthcare exposure right there. Oh, yeah. Let me do it.
My understanding of UnitedHealth was that it was just one of the better players in the industry, but my opinion is kind of shifted in terms of why they were looking so good from a margin perspective.
For what it's worth, I'm going to pull this up in ChatGPT as well. So we've got another one running in the background, but here we go. So what does UnitedHealth Group do? They're a diversified, can you see this pretty well, Ken?
Yes.
All right, diversified healthcare company operating 2 platforms. One is United Healthcare. That's health insurance and benefit services. I've been a United Healthcare provider. I was last year. I no longer am this year. I get everything on the marketplace, so we switch often. And the other is Optum. Now, this is important. It provides information and technology-enabled health services. It integrates clinical care, data analytics, and pharmaceutical management. I think it's a PBM, pharmaceutical benefits management, to lower the total costs of care. So I see a little bit of maybe vertical integration there. Now, how does it make its money? Two ways. UnitedHealth brings in 56% of the revenue. Now, look at this, Ken. I wouldn't have known this because I've never invested in UnitedHealth. Medicare is $170 billion. Medicaid is just under another $100 billion. And employers and individuals, that's just $80 billion. So that
28% of its total revenue comes from Medicare and retirement.
Yeah, that's pretty big. And I mean, if you throw these two together, that's a big number. And then Optum is the other 44%. So they've got pharmacy care, which is about 150 billion. They've got clinical care, which is about 100 billion. And then they've got their data and technology, which I imagine is higher margin, bringing in about 20 billion. So who are the customers? Well, individuals. Over about 50 million people are served through health plans, including seniors and low-income families. So that's Medicare and Medicaid. Employers, small businesses to Fortune 500 companies. Governments who contract for managed Medicaid and Medicare programs. And hospitals and clinics that use the Optum side of their revenue streams. Where does it operate? It's almost entirely in the United States. And here's the big three questions. How often do the customers buy? Well, the business is characterized by highly recurring revenue. Insurance premiums are typically paid monthly, and government or employer contracts are usually multi-year agreements. And on the Optum side, the pharmacy scripts are regularly filled, and many technology services are multi-year subscriptions. Can UnitedHealth raise prices? Yes, but within regulatory limits. Now, UnitedHealth does have significant pricing power due to scale and data. However, government-funded programs have rates set by agencies like the Center for CMS is the Center for, is it Medicare?
I think probably Medicare.
Okay. And the company recently faced margin compression due to tighter Medicare funding and rising medical costs in 2025. Finally, what happens during a recession? The business is defensive and non-cyclical. Healthcare is a must-have service. While a recession might cause a slight shift from employer-sponsored plans to Medicaid, the total number of people remains stable. And historically, UnitedHealth has maintained strong cash flows even during economic downturns, though government budget cuts are a bigger risk than a standard recession. All right, so that's a whole bunch of information we just got there. So my question is, red, yellow, green, is this attractive? Green is yes, this is an attractive business. Yellow is somewhere in between. Sorry, red is this is not an attractive business. Yellow is somewhere in between. Green is, yeah, absolutely. This is a very attractive business. And again, the ticker symbol is UNH. I'm curious, Ken, red, yellow, green, where do you fall on this?
I would say yellow, but I'm wondering if the price is starting to become green. So
okay, and we'll get to that in the valuation. Why yellow?
Yellow because there's a lot of uncertainty right now, and I am not sure exactly how to be able to project cash flows going forward or estimate them going forward.
I mean, I would be yellow too. Because like it is recession resistant. It is something that is a must have. It's not a nice to have. But for me, this also largely goes in that too hard pile. That's where it mostly goes for me, which is why I was so interested in learning more about this. We've got this one from Sergey saying he bought the dip and intend to hold for a long time. Personally, this is the kind of company or industry that you love to hate. That's true. Ken, one of the things that I've always said is you should find those companies that people hate, but they still go back to, not because you want to support them, but because that is what a moat is, right? Like, hopefully you never have to rely on the fact that you have a moat, but because you're in a capitalist society, eventually you will. It fits that bucket for me, I would say.
Oh, definitely. And this is one where I almost actually for a short time, I did buy it. I have to say, I bought it near that really low that we
Mhm.
saw last year, and I sold it for some quick gains. And part of it was just the uncertainty and my inability to understand the business yet.
And
Um,
it doesn't hurt, I will say, to get a pretty strong vote of confidence from Warren Buffett right before he retired from kind of managing the huge sloth of uh, of of Berkshire Hathaway's cash, because this was that major purchase, whether it was him or one of his associates, that they made before the end of the year last year. But by and large, what does it look like the folks that are watching have to say?
so we have a good mix of yellows and greens. There's a few reds in there, but I would
Mhm.
it's it was all yellow, and then we had some greens come in. I'd say it's about 50-50 yellow and green.
All right, I'll put yellow for now. But next, let's move on to the moat. Now, before we move on to the moat, just want to remind folks, Ken, if you could put in the chat, normally this tool that we're using and all the prompts that we have go for $199. However, if you are attending today's webinar or you're watching a replay of this on YouTube, you can use the link that is in the comment section now, and you can get Stock Simplifier for $99. Definitely a tool. I used Stock Simplifier to go through UnitedHealth for the first time today because for me, this truly is kind of from scratch. This is an area that I've stayed away from largely because it is in that too hard pile. But let's move on to the moat. Now, when we talk about a moat, we want to know
I think
if
you
there's
need to get the ticker symbol in there, Brian.
what's that?
Did you put the ticker symbol
Yes, it
in?
is in now.
Okay, perfect.
What we have now is we've got the oh, I didn't put it in. Let me put it in right here. UNH. There we go. What we've got now is we've got asking ourselves between network effects, switching costs, low cost producer, intangible assets like brand value or counter positioning. Out of those five, which one do folks think is most likely to be the primary moat that is benefiting United Health? So go ahead into the chat right now and let us know. Is it network effects? Is it switching cost? Is it low cost producer? I have my own opinions on this, Ken. I'm wondering, what do you think?
I'm going to say that switching costs possibly. Um, it could be a low cost producer in some ways in terms that its cost might be lower. But I wonder about those intangibles with
Tell me
the
more about the intangibles.
well, I don't know it well enough, but I think Optum, that technology that they have embedded into some of these hospitals,
Mhm.
could really be key to potentially having higher margin revenue coming in, and but it may be a growth area for the company.
And so, I'll tell you what I think mine would be in just a second. But what I'm going to do here is I'm going to copy this in. I'm going to put it into Gemini. I'm going to get it started, and I'll give you my opinion in just a second. But what I want to do is make sure that this can start working here. What I would say as I come back is my guess would be switching costs would be number one. And here's the big thing, Ken. Like my dad was a small business owner. And so when he had to choose a healthcare plan for his employees, there was a lot of work that went in with that. Like you've got to have your HR specialist meet with everybody, explain the benefits, pass out the cards, manage their health savings account if they have one. And I know Optum, that other arm of it, does it handles health savings accounts as well. So I definitely think the switching costs are there. To me, that would be the primary one. But I would say that there might be a secondary one for low cost producer if they're trying to become really vertically integrated, like owning and operating their own clinics. I think that's risky. Like if something like the government pulls back on Medicare reimbursements, that could really eat into their profits. However, I can see how they're trying to build that. But what do most people who replied have to say? What do they think the main moat is?
Switching costs and low cost advantages are our most replied answers.
And I see we did get some intangibles in there as well.
Yeah, intangible. There was a network effect in there.
Well, let's head over and see what Gemini had to say. So Gemini said that the moat was wide and stable. Said its primary was low-cost production and switching costs. So similar to what we said. It says it possesses a durable advantage driven by unmatched scale and vertical integration between the insurance arm and the health services platform. That makes sense. They've got almost $500 billion in revenue, and Optum's data supremacy creates a flywheel that competitors cannot easily replicate. So switching costs, wide and stable. Within its Optum, its pharmacy benefits manager and Optum Insight technology segments for large employers and government entities, changing is a massive administrative burden. And once integrated, Optum's pharmacy and data services become mission critical. A couple supporting data points. One, OptumRx reports client retention exceeding 98%. In prescription volume, it processes over 1.5 billion prescriptions annually. Quote from the company's release reflecting higher customer satisfaction. Well, there we go. OptumRx secured 750 new clients. Okay, so that is switching costs. Intangible assets, presence, but narrow. It says it holds its brand reliability, its regulatory licenses, and its proprietary data. It says that Optum Insight possesses clinical and claims data for over 285 million lives. It serves almost 50 million consumers. Network effects, present but narrow and widening. I'm guessing that this has to do with the data. As more providers use Optum for billing and clinical decisions, the data set grows richer. All right. Low cost production. This is the wide one. This is UnitedHealth's strongest moat source. As the largest private health insurer in the U.S., it wields massive negotiating power over hospitals and pharmaceutical companies, allowing it to secure the lowest unit costs for care and drugs. This monopoly-like power enables them to price premiums competitively while maintaining margins. And counter-positioning, it says no. And then we talk a little bit about the risks, regulatory and reimbursement risks. The competitive landscape, it's an oligopoly, dominated by UNH, CVS, Cigna, and Elevance, and there is a valuation risk. Morningstar gives it a narrow moat, citing efficient scale and switching costs, but it limits it to narrow for health insurers due to political risk. Gemini gives it a wide moat due to the Optum division. So that's a whole bunch of stuff right there. We talked about what we think the primary moat source is. Let's just go real quick, red, yellow, green, how wide we think that moat is. So green, you think it's super wide, the combination of moats we just talked about. Yellow, it's good, it's stable, it's not great, it's not getting wider. Red, it's coming down. Just let us know. Would you give it green, great, yellow in the middle, red, not so great at all? And Ken, let's start again, going back to you. What would you give it?
You know, I would say yellow. But I think to me, this is a little bit odd because it's got 98% renewal rates, much like ServiceNow last week that you and Brian Feraldi talked about. Mm-hmm. But it has this utility-like aspect to it where a significant amount of revenue is impacted by government rates.
Yeah. You know, I would actually give this a green for the moat, but here's what I'm going to say about that, Ken. I would only give this a yellow or a green. I would only give it one of those two, knowing that we're going to talk about the risks, mm-hmm. right? Because the risks and the government and stuff like that, that's important. So we've done the business, we've done the moat. Let's go to the next part here where we talk about the company's long-term potential. Now, they can increase the number of customers they have by sales and marketing, distribution, entering new markets. My guess is that's not going to be a big one. Acquisitions, Optum acquisition was a huge one. Or they can get their existing customers to spend more by raising prices, giving new products and services, or improving customer retention. So what I'm going to do is I'm going to go ahead and I'm going to take this prompt about long-term potential. We're going to plug it into Gemini. And while that pops up, I just would like a guess on your part, Ken, when we are talking about United Health and we're talking about its long-term potential. If we think about this in terms of the customers, new customers and existing customers, where do you think the real lever is there for United Health?
Yeah, this is a hard one for me to figure out because I don't know that they're entering new markets. I would assume that, growth above, stable, steady healthcare clients or patients would come from Optum and from prices. So I don't know that there's much room to improve customer retention. I don't know about new products or services unless you count Optum, but I think prices are the main thing to look at. And really quick, before we move on, we didn't our crowdsourced mode analysis, we didn't cover that. Everybody kind of leaned towards yellow green, but yellow was the majority.
All right, so I'm gonna go back and I'll just change that right there, so we've got yellow. Okay, so let's look and see what Gemini had to say. They said that the primary, they said it's balanced. It won't. There's not just one. So sales and marketing moderate. Its operating cost ratio remained flat at 12.9%. New distribution strong. It launched United Healthcare Store, a D2C digital platform available to 6 million members. And Optum Health value-based care models now serve 5 million patients in full risk arrangements. Interesting. Geographic expansion weak. That's not surprising. With all the regulations that are involved in healthcare, I don't see them going outside the United States. This is interesting. They say strong for acquisitions. They had a $3.3 billion acquisition of Amedisys, or a home health unit. They acquired Holston Medical Group and FlexCare Infusion to bolster care delivery density. I did not know that. That's interesting. How about existing customer expansion? Pricing power, yes. Their revenue grew 16%, even though there was only modest member growth, indicating significant premium increases. New products and services, moderate. Optum Insight grew 4%. That's not very fast. Optum Rx expanded pharmacy services, driving a 16% revenue increase. Customer retention is strong. I don't know if I would say that you can really improve that very much. So they would say that this is interesting because Gemini came up with their own, and this is great. This shows that these prompts are getting better. They came up with their own first answer, which is it's vertical integration using acquisitions. It's balanced. So acquisitions and pricing power, secondary strength for future will be distribution and new products. So given all that, what do we think about United Health's ability to grow moving forward? Is it green? Yeah, they've got a lot of growth ahead of them. Is it yellow? It's middling, or is it red? I don't see much growth. And so go ahead and put that in the comments section. Ken, again, I'm going to turn to you and ask you, what do you think when you look at this?
Yeah, I would say yellow. I think this is really a company you're looking for that long-term uninterrupted growth, that terminal value that we would talk about with valuation.
Why wouldn't you if they've got such market dominance, and this is something that's never going away, and we're innovating new drugs and new machines to help us live longer, why wouldn't it be green?
Well, I mean, you can only raise healthcare prices so much.
Because
at some point, people can't pay for it. If you look at it now, there's a minuscule lift by the CMS for Medicare rates. But we've had, I think 6 or 7% healthcare cost inflation CAGR over the last 6 years or something like that since before COVID. At some point, it's hard to keep paying, and there's a lot of political pressure.
Yeah, I would take it a step further and say the main thing for me, as far as I'm concerned, remember at the beginning, we saw that the federal government and state governments account for almost half of the company's revenue. And they're going to have something to say about those price increases. And I believe there was a time within the last month where United Health's stock was down 10, 15, maybe even more percent because the administration announced that their Medicare reimbursement rates were coming in much lower than expected. So that I would also give it a yellow. What do most of the people who are watching, what did they give it?
It is predominantly yellow.
Okay.
From the crowd.
All right, we're noticing a trend here. Okay, so the next thing we're going to do is we're going to go over the key metrics by the business phase. Now, we've said that this is a phase 5 company, and so we want to look at where UnitedHealthcare is based on phase 5 metrics. Let's see if it, Gemini might have automatically just assumed, I think it did just automatically assume we were phase 5. It's supposed to ask us. But we'll see. Maybe they're jumping ahead. They've gotten used to us doing this.
The AI is on the road.
Yeah. So for those that are unfamiliar, phase 5, what we're looking at here is their 3-year revenue growth rate, whether or not they are converting their income to free cash flow, what their interest expense looks like, return on invested capital, and whether or not there are capital returns like dividends and share buybacks. So what we're going to do here is we're going to compare the numbers to what we have in fiscal.ai to see how accurate they are. But here's what they said. Revenue, 3-year CAGR, 11.3%. That's above our 10% target. And that looks to be about right. Here in fiscal, it's 11.4. So 1 point for Gemini. Free cash flow to net income, they said it's about 100%. We can go in here and, I know Feroldi likes to pull up the percentages, but we can just pull up the numbers. We can just say, here's the net income, and then we can pull up the free cash flow, and we can look at them and say, are they about equal? And if we do, looks like I didn't get both of them. I've got free cash flow. I've got to get net income pulled up. There we go. Free cash flow is even more than net income. So that would definitely be a good thing as far as this is concerned. That's not surprising because they collect their premiums at the beginning of the year or the beginning of every month. So they would get a green there. EBIT to interest expense, the goal is 5+. Here they say it's 4.9. Ken, can you just explain what EBIT to interest expense really measures?
Yeah, that earnings before interest and taxes over your interest expenses, basically, how much of your profits are being eaten up by your interest. So kind of measuring how risky your debt profile is.
I can't remember where EBIT to interest expense is, if it's in
probably financial health.
All right, let's check. Is it not capital efficiency? You're right. It would be in financial health. Here we go. EBIT to interest expense, and they've got it at 4.7. So pretty close. But Ken, basically what that means is that they've got 5 years worth of interest expenses. They've got to pay about roughly 20% of their earnings to cover their interest. No, I'm trying to remember if I've got that right. Yeah, about 20% of their interest of their earnings go towards paying interest. Okay. And then let's see, the next one that we had here was return on invested capital. They have 8.1%. This one's very easy. We can go here and see that they say 10.2% here. That's not great. We're looking for 20% or above. I will say that healthcare is the type of industry where it's not surprising to see this number where it is. We can also see where the company has been in the past. If we go to ratios, and if we go down and we pull up capital efficiency, we can see that it's not surprising to see this return on invested capital where it is. It has never been in that 20% range. It did fall precipitously, and my understanding is the reason for this is those Medicare headwinds that the company experienced. I'm not sure if you've got any other color on that, Ken.
No, I think that has a lot to do with it. I'm also curious if they have any recent acquisitions or and what their capital expenditure load is. If that's,
we can always,
if you don't need to invest that much, then you don't need an extremely high ROIC. You just want to see the trend improving.
And you do see they've got some rather significant capital expenditures, about $3.5 billion. Now that's nothing compared to their cash from operating activities, but yeah, their net income fell by a whole bunch, and that's a big reason that it is where it is. And finally, capital returns, it's looking pretty good. So, if we look at all of these again, I'll ask folks, if you look at this green, yellow, red, what would you give it? I know where mine would be. It's got good free cash flow, good revenue. They've got not an alarming amount of debt, but some. They've got their ROIC is constrained. So go ahead and put in the chat what you would give it here. But I'm going to say we were green here. We were green here. We were technically yellow here. We were red and green. If you had to give a rating for all of that, I'm just kind of curious. Ken, do we have any color rising to the top here?
I'd say green is our majority here.
Okay. All right. So most people gave it green. And the next section is risks. Now I'm going to talk about what risks are in just a minute, but I just want to get the prompt started so that it's going. There we go. So let's talk about risks. So when we talk about risks, we're talking about this section right here. And as Mr. Froldy likes to say, we like to take all the risks and boil it down to one risk. And we call that execution risk. But right after we say we boil it down to one risk, then we break it out into four. But basically, one is concentration risk, where a couple of customers account for a ton of the revenue. The second is disruption, whether there's an identifiable disruption or the company is the disruptor. The third is outside forces like interest rates. And the last one is competition, where you want to know whether or not a company has pricing power or not. So let's look at this demo that we've got, and we will use this. And Gemini says that UnitedHealth has medium level risk. The primary risk factors is concentration, specifically in the government, and regulatory headwinds. Their key mitigation is vertical integration. So concentration, red, and trend and increasing. The US federal government is effectively the company's largest customer. Medicare and retirement and community and state account for 60% of United Healthcare revenue, far exceeding the 20% threshold. That is a lot. Disruption, yellow. While UNH is a disruptor because it has Optum, it faces operational disruption risks demonstrated by the Change Healthcare cyber attack in 2025. AI is being deployed defensively to counter this. Outside forces. This is kind of one and the same as concentration. High exposure to CMS policy, Medicare funding reductions, and elevated medical costs compressed operating margins to just 2.7%. So look at that. Operating margins were cut in half over the past year. The medical care ratio spiked to 88.9%. And I believe that the company needs to spend at least 80% of their collected premiums on medical care. And so the closer to 80% you are without going underneath it, the better. So if you're 88.9%, in theory, you're leaving 8.9% of what you could be keeping on the table. When it comes to green, it says it operates a stable oligopoly. So overall, looking at these things, what do folks say that we should give this company for our risk rating? Red, it is very, very risky. Yellow, it's kind of somewhere in between. There are risks, but they're known. Or green, there's no real risk here at all. Again, I know what I would give this, but I am curious what others think. But Ken, let's start with you.
All right. I would say risk right now, I'm kind of teetering on yellow and red. I just think we have a lot of political risk. We have talks about affordability, but maybe some of that's already priced into the stock now.
Okay. And we will talk about valuation. What do most of the people watching have to say?
Looks like yellow. Yellow is the main one, but some people are saying yellow to green, yellow to red.
All right. Well, we're getting near the end of and remember, this is our stocks from scratch, but we're getting near the end of this. And so far, I'm noticing a definite theme here of yellow, yellow, yellow. We definitely have some green when it comes to the key metrics, but In terms of risk, we're at yellow again. And finally, we want to assess the company's valuation. Now, before we get to that, just want to remind everyone again, Ken is going to put in the chat, if you want to use Stock Simplifier, get access to all the prompts that we're doing here, get access to the self-paced course, get access to all the sheets and the tools that we have. That's just $99. And that gives you access to this tool for life. So Ken will put that in the notes. But what I want to do next is let's move on to valuation. Now, valuation is the one that that AI is not great at so far. But because it's phase 5, we know that we want to look at the price to earnings and price to free cash flow ratio on a trailing basis. So if we go to fiscal, what I'm going to do here is I go to ratios. Here's trailing valuation, and I'm going to pull up the PE ratio, and I'm going to pull up the price to free cash flow ratio. What I'm going to do next is I'm just going to zero in on one of them. I'm going to pull this back as far as we can. So this goes back to 2016. And this is a company, now that we're looking at this, Ken, that has had a pretty stable PE ratio over the last decade plus until very recently. And we can put in what is the median, the minimum, and the maximum. So over the last 10 years, the median PE ratio is about 22. And right now we're at 21.4. Its low was just this past summer at a PE of 10. Its high was about a year before that at a PE of 41. But today we're sitting at a PE of 21. Any thoughts on that, Ken?
It's a little bit lower than that median.
Mm-hmm.
But when I see this, you can tell that the price is so much lower. I would expect that PE to be lower, but because earnings have fallen, that's not going the right way.
When I think about this too, because you're right, the price has fallen a lot. When I see that it's about the median, one thing that tells me is that it's not necessarily just sentiment, right? It's not that the sentiment has gone against UNH. It's that their actual results have pulled it down, because the sentiment is on a PE basis right about where it has been the last 10 years. Let's take a look at it from a free cash flow perspective to see if that paints a different picture. It's definitely cheaper. It's trading for, I don't know if you can see that, just 16 times trailing free cash flow. If we look at this though, it's pretty, the story is pretty similar. The median over the past decade is 17.3. And right now we're at 15.98. So I don't know what that is, maybe 6% undervalued. It's traded for as much as 90 times free cash flow and for as little as 8.5 times free cash flow. So again, I'm just curious, any takeaways from looking at this?
To me, what this is telling me is if you're investing in UNH, you're expecting that the market's interpretation of future results are not correct, and you think that their earnings are going to bounce back and their free cash flow is going to bounce back.
Now, for what it's worth, this isn't what we say to do in the tool, but you can always go ahead and do this, is we can look at forward valuation. And the only reason I say that is because this company was significantly affected by unexpected changes in Medicare reimbursement rates. So I'm going to pull up their forward PE ratio is about 15.5. And to put that in historical context, that is a not meaningful amount below the long-term average. So Ken, I think that kind of supports what you were just saying here, that that people are not expecting it to bounce back quite the same way that it has in the past. And then if we look at the price to free cash flow on a forward basis, it's trading for about 15 times free cash flow. But over the last 10 years, it's been a little bit higher. So yeah, there's some of that there. Maybe not on a free cash flow basis, but on an earnings basis, it looks like that's the case. So my question then, Ken, is what do folks think of this valuation? Do we think that it's a green? It's very attractive. A yellow, it's fairly valued, or a red? This is way too expensive. I see Patrick has already chimed in. Sergey asked if we think it'll ever drop to 15 or rise above 25. I mean, I don't want to make any predictions here because then we'll just look back and see how wrong I was.
I think this always boils down to the same answer in most cases, which is it depends.
Well, and for you, what does it depend on? Because if you can't give people a certain answer, let's at least tell them what to watch.
Yeah, and if somebody knows this company better than I do, feel free to offer a counterpoint. But my interpretation of UNH is that their margins were always considered to be higher than most other providers.
Mm-hmm.
But the story has changed because some of their practices are coming under scrutiny, including declining coverage for procedures. So, which I have a personal experience with a family member of mine. And if that is the case, then maybe those profit margins were abnormally high and they're coming down. And I think that might be what the market is looking at right now, is that maybe they're not going to return to the profit margins they had before. So that is going to change the forward outlook. With that said, the stock has come down a lot. So,
well, I will say one thing I'm surprised by. So I look at this and I think this looks fairly valued. And then I go to this, which is the stock chart over the past, even if we just go over the past 3 years, and I say, whoa, this is down a bunch. It used to be as high as 625, and now it's been more than cut in half. This really shows that I would argue that there's a little bit of sentiment here, but most of this has to do with their actual results, because it hasn't changed all that much. So would you say that we got a yellow for both of these?
I'd say probably a yellow.
Okay. Well, then let's bring this home. And oh, you know what? I forgot about our sentiment survey. Let's do the sentiment survey real quick. Now, one thing I always like to do in the sentiment surveys, I like to actually do this in Grok because it has access to kind of anyone on FinTwit who's making comments about things. So we'll take the price in sentiment analysis, we'll copy it, we'll put it into Grok, and I'm curious what they'll have to say.
I always think of this through Grok as the everyone and their mother survey. As you know, we like to say everyone and their mother has an opinion.
I'm curious what, if it's going through all the different posts that are on Twitter, what it has to say about the sentiment for UnitedHealth, because certainly Berkshire Hathaway purchasing is a big deal. Certainly seeing prices as low as they haven't seen in a long time is a big deal. But at the same time, there are all those headwinds that you and I were just talking about.
And we have a take from Uma, who has an X logo.
Please.
In Uma's profile says, I've been saying this for a very long time. UNH is another Enron. So there's a negative sentiment from someone with an X logo in their profile pic.
Wow, look at that. I'm not used to Grok taking quite so long to do these prompts as it is. Man. All right, well, I tell you what, while it does that, Ken, let's go to this last part, because this is just folks throwing things into the chat. What do you think of UnitedHealth? Is this a company that you're going to, at the end of this, go out and buy it right away? Okay, you're like, man, this was amazing. That's a green. Is it one where you're like, I own it and I'm going to sell it right away? That's a red. And a yellow is anywhere in between those two. I'm just kind of curious what people have to say. Is it a red, a yellow, or a green? Go ahead and put that in the chat. We'll come back to those in just a second, but I do want to check. Man, Grok is still going. Jeez. Well, all right. Well, Ken, what do we got here? What are people saying?
We have a bunch of no's and a bunch of yellows. So and a red just came through from Olivier. Hi, Olivier.
A yellow and a difference between a yellow and a red. Yeah, I don't see a single green in all of this. So if we were to go here, it looks like this is like a red or a yellow. Let's check back with Grok. It is still going. Holy moly. Well,
Now we've got a green from
Okay,
David.
we got one
Green
green.
for a value investment. And
All right.
Vladislav, another green. So we do have a couple greens coming in.
Well, Ken, I'm going to keep my eye on Grok to see if it comes up with any, but we've got a couple minutes left. I'm just curious, were there any questions that you saw that came up that'd be worth just kind of touching on, or did you observe anything that you think is worth bringing up as well?
One thing I would look into if I were going to potentially buy UnitedHealth would be Optum. I'd want to learn more about that and see if there is potential to grow market share with their digital platform.
Mm-hmm.
And then this is one of those companies, I know we're not really talking about it today, but I would maybe use a little bit of technical analysis on this
Okay.
for risk management, only because I just don't understand it well enough fundamentally.
So that's the
and
way that you
sometimes
like mitigate your lack of circle of competence.
exactly, just to give me, not to swing trade it, but just to give me something to say, all right, maybe this is not a good investment right now. Some kind of get out or buy more or get in.
I know for me, it's just the too hard pile. Like
Mhm.
it's the beautiful thing about investing is you don't have to swing at every pitch. I tell this story all the time. My son is 7. He plays machine pitch baseball in Little League, and they don't call strikes. The best hitter on his team will stand up there and just watch 10 pitches go by, and the coaches get a little upset. And finally, he sees one that he likes, and he just smacks it. And they don't have a fence, but he gets a home run all the time. He's going to have a tough time when he goes up the next level and they call strikes. But investing is like being that kid. You don't have to swing at every single pitch. I do want to just hit on this real quick. So I do think we've got a response here from Grok. So let's see what Grok had to say. So earnings missed. Why it moved? Earnings missed, and it lowered profit guidance in early 2025, triggering sharp sell-offs. The Medicare Advantage rate pressures and higher medical costs led to a weak outlook and sustained declines, resulting in a 45% drop. The next catalyst will be first quarter earnings, which will come out around mid to late April. The outlook is neutral. Analysts maintain a strong buy with 30% upside potential, but regulatory and cost headwinds create meaningful near-term risks. Analysts are mostly bullish. Investors are neutral. The media is negative. That's not surprising. Over the last 12 months, the mood shifted from stable to sharply negative with earnings shocks, guidance cuts, Medicare Advantage pressures. The key signals, analyst consensus, they still call it a strong buy, but the media headlines are really focused on the declines. The retail sentiment, predominantly bullish tilt with dip buying interest. The bulls say 30% upside. The bears say the lower guidance is a big problem. There was an abrupt CEO departure in May. So there you go. That's what Grok had to say about what people were thinking. One last thing, and I'm glad that Vlad appreciates my baseball machine pitch analogy. One last thing, Ken, is we'd love suggestions for what stocks do you want to see us do on here now. Ken, I don't know about you, but the last couple of weeks, the markets seem fine, but the area that I play in, not so fine. Software especially, man, having a tough time. What stocks, they don't have to be software, but there's a lot of interest in them right now. What stocks would you like to see us cover? Put them in right now. So I see, like, for instance, Vlad says CrowdStrike. We can put that on our list. Let us know. HPQ. I don't know what USAR. I know Race. That's Ferrari and Fiserv, consulting companies. We will put this in our newsletter, and folks get to vote on this. And yeah, I see Jacques put PayPal in there. Man, they're having another really, really tough day.
USAR is a rare earth ETF, I think. Or
okay,
is that an ETF? I don't know. It's up 16% today. and it says rare earth something. I don't know if it's a
So
company.
let us know. We will put that in our newsletter. We'll let people vote on it. Yeah, Sergey, Unity is another option, interesting one. It was up a bunch, and Google came out with a new tool, and it's just been diving and diving ever since. Yeah,
And that's
so
the Sprouts Farmers Market.
yeah, we've got a
That's
couple
right up
for
my alley.
interesting.
Same thing.
All right. Well, so that was how we researched United Healthcare stocks from scratch. Ken, you've owned it a little bit in the past, not anymore. I've never owned it. It's in my too hard pile. And it seems like largely going through Stock Simplifier, this is where we ended up with it in general as well. Of course, we've got a track record of this now, so we can check back and hopefully learn from whatever mistakes we've made to see if what we put down matches what others have to say. Ken, thanks so much for joining us this week.
You're welcome. Thanks for having me on. It's been fun.
All right. Well, next week, Mr. Feroldi will be back from his skiing trip, so he'll be back. And Ken, it's good to know you're always here to fill in. Thank you, everybody, for joining us this week. Ken and Brian, out.